Cryptocurrency is unpredictable and high risk. Nobody knows when it'll reach its peak, and it's even harder to predict when it's going to suddenly go bankrupt. A few months ago, Terra Luna collapsed and rocked the whole industry to its core. This time, it's FTX Alameda. In this video, we'll be taking a look at the fall of FTX and Alameda, and Morgan Stanley's opinion on what will follow next, so stay tuned. First off, Morgan Stanley's take on FTX and Alameda collapse. At its peak, FTX was one of the biggest cryptocurrencies in the world. Even at other times, it was doing really well, so it's understandable that Alameda's fall has sent a shockwave among crypto users. Let's just say people aren't that sure about the whole cryptocurrency and the new financial system anymore. As a result of people starting to doubt if the promises of cryptocurrency were ever real or just a delusion, there will yet be another round of deleveraging in the market. That said, this has happened before, both in the collapse of a major cryptocurrency and people finding newfound doubts about the industry. The prime example being the crash of sister cryptos Terra and Luna. According to Morgan Stanley, this will probably result in a crypto quantitative tightening. Creditors, in a panic, have started to sell digital assets in an attempt to cover their risks. So, this will only add to the market's volatility and will also probably reveal their exposures in the next few weeks. Up until now, the only reason the spillover to equity markets is still so limited is the fact that crypto firms attempt to only lend among themselves, Morgan's report said. And so, these events will eventually lead to the dreaded but inevitable bout of volatility in the crypto industry. And that's where the key question arises, which is how to value crypto tokens that offer a service but don't offer the token holder a stake in the company, meaning equity or a claim on assets in the case of a default meaning debt. Next up, why it may be more problematic than the Terra Luna collapse. He added that if a bull market uses such a token as a security, then that was fine. On the other hand, anyone from the bear market using the same strategy will be taking a huge risk. The bear market has been active in Bitcoin for about a year, and for the most part, it's been institutions that have been selling. Retail investors, however, are doing a good job of holding on to their positions. Bitcoin is currently trading under $17,000, and it's likely that retail investors won't start selling until the trades drop below at least $10,000. For now, decentralized finance lending has proved to be just as resilient as it was in June after the collapse of the sister cryptocurrencies Terra and Luna. Centralized finance lending, though, may cause a bit of a problem. FTX's collapse has had a huge impact on the crypto market. The toll has sent the price of Bitcoin tumbling down about 21%, and paired with that, as well as other currencies that are also struggling, the market has lost about $82 billion since November 6th. JP Morgan strategist has reported that this phase of crypto deleveraging, triggered by the fall of FTX and Alameda, will be much more problematic than the phase that arose due to Terra and Luna. Why? Well, according to the strategists who are being led by Nikolaos Panagirtsoglou, the problem is that the number of organizations or establishments that have stronger balance sheets and, as a result, rescued those with high leverage and low capital during the previous collapse have decreased alarmingly. Now for how this will affect the crypto market. The strategists pointed out that the whole system of how things were currently working would alter due to FTX's collapse. The people investing in the crypto market will be much more careful and wary of losses, and as a result, adopt a much more diligent risk management. Investors and regulators, on the other hand, will take to pressurizing the crypto businesses to disclose more information, limit asset concentration, and safeguard client assets. Despite everything, the hit to the market due to the deleveraging cycle that will hit its peak in a few weeks may actually be smaller than what happened after the Terra Luna collapse. This was because the advanced deleveraging that took place before the Alameda FTX collapse. Global data analyst Sunit Muru said that the fall of FTX and everything that will follow is a classic example of short-term pain and long-term gain. By this, he meant that over the next few months, the crypto market cap will deflate. But while this will cause some loss, it will eventually force exchanges to once again attempt more effective risk management. But of course, as much as we attempt to look at the bright side, something like this will also bring a lot of damage to the industry. The perfect example of this is the decline of Bitcoin. Lastly, there's still a lot of leverage in the crypto market. Bitcoin is extremely important in the crypto market, and the production cost has been known to lay the foundation of the token's price. Seeing as it was at $16,500, which is already pretty low, and the strategist predicted that it will soon fall to $13,000 or less, we can say that it has taken a pretty bad hit. The strategists agreed that there was still too much leverage in the crypto market. They said that currently, the market was in the middle of another deleveraging event, and up until now, the spillover to broader equity markets is because the crypto institutions lent to each other. We all know that the collapse of two important cryptocurrencies will have a huge impact on the market. After all, everyone experienced it with the Terra Luna crash, which merely took place a few months ago. Fortunately, though, it looks like that just like last time, the market will recover from all the losses and the major collapse and may even end up becoming even stronger. Moving on to how crypto's future may be divided, not dead. First up, the collapse of the SBF empire. Just when it looked as if the world of crypto couldn't get any crazier, it has. Not long ago, Sam Bankman-Fried had an empire worth over $32 billion, which consisted of the FTX crypto brokerage and Alameda Fund. He used to be a philanthropist and sports sponsor and was backed by mainstream financiers like BlackRock. This isn't the case any longer. It was revealed by the SBF that FTX had seen $6 billion in customer withdrawals. It tried to sell itself to its arch-rival Binance, the biggest crypto exchange, but failed. And now, if he can't plug the $8 billion liquidity hole, he'll go bankrupt. This can be considered as crypto's version of the Lehman Brothers shock in 2008. Currently, the crypto universe is only $1 trillion. This is a third of its size last year. Crypto tokens mostly operate like chips in a casino and can only be used there, but the FTX fiasco unleashed crypto contagion, deflating the bubble that was previously pumped up by cheap fiat currency even more. Will all this lead to crypto dying out? It can't be said for sure, but in the short term, many of the mainstream institutions and investors will run away from the industry. That is unless a sweeping regulatory reform is carried out. That's because two big weaknesses of the sector were revealed with the implosion of the FTX. Following up, two problems plaguing the world of crypto. The first weakness is that it's extremely difficult to find out what assets underpin digital tokens. After all, the balance sheets are more often than not opaque. It was thought that Alameda and FTX are well capitalized, but last week it was suggested in a report that their balance sheets were padded by large holdings of a digital token known as FTT, which was issued by FTX itself. This news hasn't been confirmed by FTX, but it's clear that what caused the token's price to collapse was a tweet by the head of finance, Changpeng Zhao, saying that he planned to dump his holdings in FTT. Opacity has its own consequences. The second problem in crypto is custody. Practices have been a dangerous mess in this regard for a long time. The SBF empire was a broker, lender, proprietary trader, and custodian for the crypto world all at once. Reportedly, it rehypothecated assets on a large scale. Ironically, concentrations of power were created by this, which is against the decentralization mantra of crypto. This also means that customers may not recoup their funds. This is what resulted in the panic, the lack of a safety net for investors or lenders of last resort in the crypto world. Finally, despite the issues, crypto probably won't die. Theoretically, these problems can be fixed if crypto takes on the same regulatory tenets around transparency and custody as fiat-based finance, and investors may stay involved. But the attitudes of crypto players towards regulation are mixed. Despite everything, it's a mistake to assume that crypto has died because a large number of players use digital assets to evade government controls for many reasons. Another reason is that, even if private sector crypto assets drop in value, governments have already been copying some of the underlying technologies for their own use. Keeping all this in mind, it seems that crypto's future may be split but not dead. That's a wrap for this video. How do you think FTX's collapse will affect the market? Let us know in the comments below. Make sure to give this video a thumbs up and subscribe to our channel for more videos like this. See you in the next one.